Alright, so now let's allocate the cost into the three groups. And we'll start with the first group, which is the inventory in process on July 1st, which is the amount of inventory that has been transferred over from the month of June. So they say here that the 5,000 gallons of inventory in process on July 1st, or Group 1, were completed and transferred out to the packaging department in July. So if you look here, we have the inventory in process, July balance. The total cost was $6,225. And if you go back here, you will see how we got this value. It was $5,000 in direct material and $1,225 for the conversion cost. Remember, it was only 70% completed, and we completed the remaining 30% in July. So this value is the value of the inventory that was transferred. The equivalent units for completing the July 1st in process inventory for direct material was 0. Remember, for material it was 100% used in June. But for the conversion it was 1,500. And let me again go back and this is where we got the 1,500. I think this is a 1,500. Remember, this is the conversion equivalent units. So the 1,500 are the conversion or the units that were, or the equivalent units for completing all of the conversion cost. So the cost per equivalent unit, it was for direct material was 1.10 cents or $1.10, and for the conversion cost it was only 30 cents. So multiply each direct material with its equivalent or the cost per equivalent unit, and you will get cost of completed July 1st in process inventory. So for material it's 0, for the conversion it's the 1,500 multiplied by 30 cents, that's $450. So the total is $450. We added to the inventory in process that we moved forward, or we moved over from the month of June, and that would be the cost of July in process inventory transferred to packaging department, which is $6,675. That's Group 1, and remember, Group 1 was all transferred to the packaging department, which is the next department. For Group 2, which is the started and completed, remember we have Group 2 started and completed, and we have also Group 3, which is this inventory still in process that wasn't completed. So we had 60,000 units. These were whole units that we started, but 57,000 units, these are the ones that are started uncompleted. And these would fall under Group 2. They incurred all 100% of their direct material and conversion costs in July. So for these it's going to be easy because it's going to be 100%. So look at the cost here. The units started and completed in July. We have 57,000, and these are the numbers that we're going to be using for the direct material cost and for the conversion cost. I hope you still remember, conversion cost includes labor cost and the factory overhead. The cost per equivalent unit, we still have it as $1.10 for the month of July and 30 cents also for the month of July for the conversion cost. Multiply these numbers and we get 62,700 and 17,100. We add them together and that would be the cost of the unit started and completed in July, which is this value. So we started 57,000 gallons of ice cream, and the cost for these were $79,800. The total cost of $86,475 transferred to the packaging department in July is the sum of Group number 1 and Group 2. So we had $6,675 from the previous slide here, and then $79,800 from this value here. Add them together, that's $86,475. That's the total cost transferred to packaging department in July. Now let's see the last group, Group 3, for the inventory in process on July 31st. If we know the total cost, which is $90,000, we subtract from it the $86,475, which is the amount of the cost transferred out to the packaging. Now we can know the inventory in process cost that's still in our ending value or ending balance. These are representing 3,000 gallons. But we're going to do the math for the same way we've done it for Group 1 and 2. So the 3,000 gallons in process on July 31st, which are Group 3, incurred all their direct material cost and 25% of their conversion cost. So for direct material, we have the entire 3,000 gallons. For conversion cost, it's the 3,000 multiplied by 25%, and that's 750. Let's multiply them again by the cost per equivalent unit, $1.10 for the material and 30 cents for the conversion. And that would be the cost of July 31st in-process inventory, $3,300 for material, $225 for conversion, for a total cost of $35.25, which is what I just told you about here. So let's put together the three groups. Group number one, inventory in process, that was moved forward from June, or moved over from June. So these were completed and sent to the next department, or the packaging department. The whole units are 5,000 gallons. The total cost is $6,675. Group 2, we have 57,000. These were started and completed for a cost of $79,800. So the total transferred out to the packaging department in July is 62,000 gallons for a total cost of $86,475. Group 3 are the remaining inventory in process. These are 3,000 gallons, and remember, these are the whole units because they were only completed by 25%, and but here we're only considering the whole units value, which is 3,000, and the total cost would be $35.25. So all in all, we have 65,000 gallons for a total cost of $90,000. You can do this on Excel using an Excel sheet, and I really encourage you to consider playing with these numbers on an Excel sheet. I think that's a very useful tool for accountants, and I think you'll be doing yourself a favor if you start playing with these numbers and try to see how you can create equations to do the math for you. And here we have the step 1, step 2, step 3, and step 4, and the total cost, which is the 90,000, the ending inventory, the transfer to packaging, which is the 86,475. You can do this and you can apply what you learned. Now let's try a knowledge check. And again, this is just to check our knowledge for some of the concepts. So what is the number of units in production during a period, whether completed or not? What do we call it? Do we call it whole units? Do we call it equivalent units of production, partial units, or converted units? I don't think it cannot be C or D. We never talked about partial or converted units, but we talked about whole units and equivalent units. And the number of units in production during a period, whether completed or not, that's the whole units. So the right answer is whole units. Whole units are the number of units in production during a period, whether completed or not. On the other side, equivalent units of production are the portion of the whole units that are complete with respect to materials or conversion. So that's only when we focus on direct labor and factory overhead cost. The next thing we want to do is to see the journal entries for process costing. And I think this is easy. If you did well in financial accounting, that should be very easy for you. So the journal entries to record frozen delights, cost flows, and July transactions for process costing are illustrated and shown in summary form, even though many of the transactions would be recorded daily. So purchase material, including milk, cream, sugar, packaging, and indirect material on account for $88,000. We're going to debit material, and remember, materials is part of your inventory. It's an asset, so we debit it for $88,000. And we credit, assuming that we bought it on account, we credit accounts payable for $88,000. Remember, accounts payable is a current liability, and that's why it's on the credit side. The mixing department's requisitioned milk, cream, and sugar for a total of $66,000. This is the total amount from the original July data. Packaging material of $8,000 were requisitioned or requested by the packaging department. Indirect material for the mixing and packaging department were $4,125 and $3,000 respectively. So we're going to record this. So work in process for mixing is $66,000. We debit work in process for packaging of $8,000. We can record the factory overhead, and we debit the factory overhead. And we credit that to material. Remember, previously we recorded $88,000, and maybe we had a previous balance of material. Now we're crediting the material for $81.25. And all of these were transferred to the work in process and the factory overhead. We also incurred direct labor in the mixing and packaging department of $10,500 and $12,000 respectively. So we debit work in process mixing, work in process packaging, and we credit the wages payable for $22,500, which is the total of these. So keep in mind, we have the direct labor, we have the direct material, and we also have the overhead. So recognize equipment depreciation for mixing and packaging department of $3,350 and $1,000 respectively, and that would be part of the factory overhead for mixing and the factory overhead for packaging. So the total of that would be credited to accumulated depreciation for equipment for $4,350. Another applied factory overhead to mixing and packaging departments of $7,275 and $3,500 respectively. So we're going to debit work in process for mixing and work in process for packaging, and we credit the factory overhead for mixing and packaging. So now we had the material, we had the labor, which is the wages payable, and now we have the factory overhead. And all of these were transferred to work in process. Remember, these are the applied factory overhead. This is how we've done it in the previous chapter. Then we transfer cost of $86,475 from the mixing department to the packaging department per the cost of production report shown earlier. So when we have a debit to work in process for packaging, that means that work in process and packaging increased. And when we have a work in process on the credit side for mixing, that means that these were transferred out of mixing department, so we reduced the work in process in mixing. So we have the values here, $86,475. Just to refresh your memory, we got this value from here. That's the $86,475. That was the amount of the Group 1 and Group 2 combined. Then we transfer goods of $106,000 out of the packaging department to finished goods according to the packaging department cost of production report. So that would be debiting the finished goods because now the finished goods are increasing, and we're crediting the work in process for packaging. And the very last thing is to recorded the cost of goods sold out of the finished goods inventory of $107,000. Remember, this is the cost, not the selling price. So we're going to debit cost of goods sold and credit finished goods for $107. So we can see this on the T accounts. We have the material, we have the factory overhead, we had for mixing and packaging, we had the work in process for mixing and packaging. Please notice that we transfer from mixing to packaging, and then it goes to finished goods, and then finally to cost of goods sold. Alright, so let's do another knowledge check. Part3 Manufacturing Incorporated uses a process costing system in its production. During the past month, it transferred completed goods of $95,000 ready to be sold out of the final assembly department per its cost of production report. So pay attention to that. It transferred completed goods of $95,000 ready to be sold. So in other words, it transferred to finished goods. Which of the following would be the proper transaction to record this activity? So let's start with A. We debit work in process, final assembly department, $95,000, and we credit finished goods. Now I don't accept that because finished goods should be on the debit side, because this is what we transfer to, and we should credit the work in process. Debit cost of goods sold and credit finished goods, again the same issue. Finished goods cannot be in the credit side, and then we didn't sell it yet, we just transferred it into finished goods. Debit finished goods and credit work in process final assembly department. I think this is tempting. We're increasing the finished goods, we're reducing the work in process for the final assembly department because now it's transferred to finished goods. Let's see the last one, maybe we missed something. Debit finished goods and credit cost of goods sold. No, cost of goods sold is whenever it is sold. So the right answer would be C. So debit finished goods for 95,000, and we credit work in process for final assembly department. So when goods are completed and ready to be sold, the costs are removed from the work in process by crediting them and adding them to the finished good inventory and debiting them. Alright, so now let's talk about using the cost of production report. So how is that helpful in any kind of decision? The cost of production report is often used by managers for analyzing the change in the conversion in direct material cost per equivalent units between periods. So I think we've seen the months of July. We can compare the numbers to the month of June and see how the company is doing. So in our example here, Frozen Delight's cost of production report for the mixing department shows that beginning inventory is 6,225. The July 1st inventory in process of 6,225 consists of the following. We have direct material of 5,000 and we have conversion costs for the 5,000, which were 70% completed for a total of 1,225. So the total inventory in process was 6,225. Now let's see 5,000 gallons. Okay, so that seems like the direct material were $1 a gallon. And we divide the same thing. So let's just see this in the next slide. So the direct material cost per equivalent were 5,000 divided by the 5,000 gallon. So it's $1 per gallon. For the conversion cost per equivalent unit, we have the 12 or the 1,225 divided by the 5,000 gallons that were only 70% completed, so that would be 3,500 gallons. So we take this value divided by the 3,500 gallon, and it's going to be 35 cents per gallon. So in July, the cost per equivalent units of material increased by 10 cents. You can see here, it used to be $1, now it's $1.10. While the cost per equivalent units for conversion cost, remember conversion cost includes labor and overhead, decreased by $5 per gallon. So 35 cents, now it's 30. So there's a decrease. So this kind of analysis is usually useful for managers to know what's going on. So Frozen Delights management could use the preceding analysis as a basis for investigating the increase in the direct material cost per equivalent unit and the decrease in the conversion cost per equivalent unit. Let's do another quick knowledge check. The cost of production report is often used by managers for analyzing the change in the conversion and direct material cost per the whole units between periods, equivalent units between periods, partial unit between periods, completed units between periods. Again, let's think about this again. The cost of production report is often used by managers for analyzing the changes or the change in the conversion and direct material cost per. The right answer here is equivalent units between periods. So the change in the conversion and direct material cost per equivalent unit between periods is analyzed by managers so they can determine any concerns that should be addressed to avoid higher than necessary cost going forward. So again, we use equivalent units, not the whole units. So let's try to see how we can use this for analysis. So analysis for decision making, or in other words, analyzing the process cost. Cost of production reports may be prepared showing more than direct material and conversion costs, which can help managers isolate problems and seek opportunities for improvement. So assume we have this beverage company called Holland Beverage Company. Blending department had no beginning or ending work in process inventory in April or May. So whatever they produce, they just get out. All units started were completed in each month. The cost of production reports showing multiple cost categories for April and May in the blending department are as follows. So we have material, we have labor, we have energy, repairs, tank cleaning, and then we have the total, and then the units completed, and then the cost per unit. And you can see that the cost per unit was 50 cents in total, and now it's 53 cents. But let's do more analysis. So by comparing these details and trying to see the changes, we can pinpoint that the energy and the tank cleaning were the biggest increase. Okay, even though the total increase was 6%, repairs had nothing different. Actually, the labor there was some decline, but there was a 25% increase in energy and 33% increase in tank cleaning. So the report indicated that the total unit costs have increased in May from 50 cents to 53 cents, which is about 6% increase. To determine the possible causes for this increase, the cost of production reports are restated in per unit terms by dividing the cost by the number of units completed. Both energy and tank cleaning per unit cost have increased significantly in May. These increases should be further investigated. So that as a manager, I would be concerned about energy. Why we have this kind of increase in energy? Why we have such an increase in tank cleaning? And so on. And that's how management accounting gets to be useful. Alright, so by this, we conclude Chapter 17. I hope you enjoyed that chapter, and I wish you all the best.